My name is Roy.
Hi, I am Rodrigo.
I'm Mary. When someone sees an insurance policy, they just care about the benefit in the face of possible sinisters and not about of what's behind of it. For this reason, we're gonna talk you about the methods of the insurance career do you use to get that goal. Reinsurance is insurance that is purchased by an insurance company. In the classic case, reinsurance allows insurance company to remain solvent after major claims events, such as major disasters like hurricanes and wildfires. In addition to its basic role in risk management, reinsurance is sometimes used for mitigation and other reasons. The company that purchased the reinsurance policy is called the ceding company, or cedent or cedant. Under most arrangements, the company issuing the reinsurance policy is referred simply as the reinsurer. A company that purchases reinsurance pays a premium to the reinsurance company, who in exchange will pay a share of the claims incurred by the purchasing company. Insurance companies that sell reinsurance refer to the business as assumed reinsurance.
There are two basic methods of reinsurance. First, facultative reinsurance, which is negotiated separately for each insurance policy that is reinsured. Is normally purchased by ceding companies for individual risks not covered if insufficiently covered by their insurance treaties for amount is excessive of the monetary limits of their insurance treaties and for unusual risks. Ultimately, a facultative certificate is issued by the reinsurance company to the ceding company reinsured that one policy. Second, treaty reinsurance means that the ceding companies and the reinsurance negotiate and execute an reinsurance contracts under which the reinsurer covers the specific share of the all insurance policy issued by the ceding company which come within the scope of that contract. The reinsurance contracts may obligate the reinsurer to accept reinsurance of all contracts within the scope now as obligatory reinsurance, or it may allow the insurers to choose which risks it wants to set, which the reinsurance obligate to accept such risks.
Functions. Almost all insurance companies have a reinsurance program. The main goal of the program is to reduce their exposure to loss by passing part of the risk of loss to a reinsurer or a group of reinsurers. Risk transferred. With reinsurance, the insurer can issue policies with higher limits than would otherwise be allowed, thus being able to take on more risk because some of that risk is now transferred to the reinsurer. Income smoothing. Reinsurance can make an insurance company results more predictable by absorbing layer losses and reducing the amount of capital needed to provide coverage. The income smoothing comes forward as the losses of the cedant are essentially limited.
Arbitrage. The insurance company may be motivated by arbitrage in purchasing reinsurance coverage at a lower rate than they charge the insured for the underlying risk, whatever the class of insurance. In general, the reinsurer may be able to cover the risk at a lower premium than the insured because the reinsured may have some intrinsic cost advantage due to the economies of scale or some other efficiency. Reinsurers may operate under weaker regulation than their clients. This enables them to use less capital to cover any risk and to make less conservative assumptions when valuing the risk. Reinsurers may operate under a more favorable tax regime than their clients. Reinsurance will often have better access to underwriting expertise and to claims experience data, enabling them to assess the risks more accurately and reduce the need for contingency margins increasing the risk. Even if the regulatory standards are the same, the reinsurer may be able to hold smaller actuarial reserves than the cedant if it thinks the premiums repurchased by the cedant are excessively conservative. The reinsurer may have more diverse portfolio of assets and especially liabilities than the cedant. The reinsurer may have the greater risk appetite than the insurer. Reinsurance expertise. The insurance company may want to avail itself of the expertise of a reinsurer or the reinsurer's ability to set an appropriate premium in regard to a specific risk. The reinsurer will also wish to apply this expertise to the underwriting in order to protect their own interest. Creating a manageable and profitable portfolio of insured risks. The insurance company may be able to create a more balanced and homogeneous portfolio of insured risks. This will lend greater predictability to the portfolio results on a basis and could be reflected in income smoothing.
Types of reinsurance. Proportional. Under proportional reinsurance, one or more reinsurers take a stated percentage share of each policy that an insurer issues. The reinsurer will then receive that stated percentage of the premiums and will pay the stated percentage of claims. The arrangement may be quota share or surplus reinsurance or a combination of the two. Under a quota share arrangement, a fixed percentage of each insurance policy is reinsured. Under a surplus share arrangement, the ceding company decides on the retention limit, say $100,000. The ceding company retains the full amount of each risk, with a maximum of 100,000 per policy or per risk, and the balance of the risk in reinsurance. The ceding company may seek a quota share arrangement for several reasons. First, it may not have sufficient capital to prudently retain all the business that it can sell. For example, it might only be available to offer a total of $100 million in coverage, but by reinsuring 75% of it, it can sell 4 times as much. The ceding company may seek surplus reinsurance to limit the losses it might incur from a small number of large claims as a result of random fluctuations in experience. The maximum automatic underwriting capacity of the cedant would be $1 million in this example. Any policy larger than this would require facultative reinsurance.
Non-proportional. Under non-proportional reinsurance, the insurer only pays out if the total claims suffered by the insurer in a given period exceed a estimate amount, which is called the retention or priority. The main forms of non-proportional reinsurance are excess of loss and stop loss. Excess of the loss reinsurance can have 3 forms: per risk risk XL, working XL, per occurrence or per event XL, catastrophe or CAT XL, and aggregate XL. In per risk, the cedant's insured policy limits are greater than the reinsured retention. Contracts usually contain event limits to prevent their misuse as a substitute for catastrophe XLS. In catastrophe excess of loss, the cedant retention is usually a multiple of the underlying policy limits, and the reinsurance contract usually contains a 2-risk guarantee.
Risk attacking basis. A basis under which reinsurance is provided for claims arising from policies commencing during the period to which the reinsurance relates. The insurer knows there is coverage during the whole policy period, even if claims are only discovered or made later on. All claims from Zidane underlying policies incepting during the period of the reinsurance contract are covered even if they occur after the expiration of the insurance contract. Any claims from Zidane underlying policies incepting outside the period of the reinsurance contract are not covered even if they occur during the period of the reinsurance contract.
Losses occurring basic are reinsured treaty under which all claims occurring during the period of the contract, irrespective of when the underlying policies inspected, are covered. Any loss occurring after the contract's experience date are not covered, as opposed to claims made of risks attaching contracts. Insurance cover is provided for loss occurring in the definite period. This is usual basic of cover for short tail use. Claims made basic. A policy which covers all claims report to an insured within the policy period irrespective of when they occur. Contracts. Reinsurance can also be purchased on a per policy basis, in which case is known as a facultative reinsurance. Facultative reinsurance can be written on either a quota share or excessive of loss basis. Facultative reinsurance contracts are commonly memorialized in relatively brief contracts, known as facultative certificates, and often are used for legs unusual risks that do not fit within standard reinsurance treaties due to their exclusion.
Fronting. Sometimes insurance companies wish to offer insurance in jurisdictions where they are not licensed. For example, an insurer may wish to offer an insurance program to a multinational company to cover property and liability risks in many countries around the world. In such situations, the insurance company might find a local insurance company which is authorized in the relevant country, arrange for the local insurer to issue an insurance policy covering the risk in that country, and enter into an insurance contract with the local insurer to transfer the risks. Fronting is also sometimes used where an insurance buyer requires its insurance to have a certain financial strength rating, and the prospective insurer does not satisfy that requirement. The prospective insurer may be able to persuade another insurer with the requisite credit rating to provide the coverage to the insurance buyer and to take the reinsurance in respect of the risk. The fronting insurer is taking a risk in such transactions because it has an obligation to pay its insurance claims, even if the reinsurer becomes insolvent and fails to reimburse the claims.
Thanks for watching.